Well, we have a market that continues to bounce with the majors all above their 200-day moving averages. The Nasdaq just having cleared its 200-day. And the burning question is how much further can this market bounce? It has defied a lot of the short sellers out there who want to believe that that things are not good. Things aren't good, but that doesn't mean that all these central banks can't win, or at least temporarily win, this tug of war by printing money ad nauseum. And they're all in unison. They're all in this chorus together. So don't fight the Fed is don't fight the Feds. And these bounces can continue a lot longer than we think. As 2009 to present day has shown, of course, not without the market's corrections, but nevertheless, this is an unprecedented time. So we could see that this market just continues in its way into new highs, but keeping in mind that the issue, the real burning issue here is that the global economy is not well, and there's no signs of it being cured by these central bank antics of reducing rates now into negative territory with the Bank of Japan and the ECB. And Yellen herself has not ruled out the possibility of this sort of situation in the U.S. if warranted. I can just see that in the future, should the global economy continue to drag, central banks, more central banks will join that negative rate bandwagon, and there will be an increased loss of confidence because it's pretty clear right now the Fed is not known, the central banks don't know what they're doing, and there's a growing dis-ease going on among investors, and we saw that action in 2015 with the sideways markets reluctant to go higher. Certainly that was a change from 2009 through 2012 when the Fed used all sorts of tricks, for, quantitative easing tricks to push the markets higher. And they did go higher, even though it was not an easy rally to play. None of those years were. But 2013 came along, and then that was met with very aggressive QE. So the floors, I think the S&P didn't have any correction beyond 5 or 6% that whole year, which is pretty unprecedented. And that was a very difficult year because every time it looked like the stocks were going to fall off the cliff, they continued higher, finding shallow floors. And then 2015, there's been just this sideways action that has been billed by some media accounts as the toughest year to make headway in 78 years. And now this year we have a kind of a cataclysm at the beginning of the year, and I think there's enough telegraphing activity that markets are not pleased. So nevertheless, to predict these things is foolhardy because the future, as Ed Sekoda always says, does not exist. So you just have to watch your stocks. Watching these stocks shows us that leading stocks are still lagging. They're you look at Facebook, you look at Google, Amazon, etc., and these are defective patterns. It's like they're getting pushed higher reluctantly just because the major averages are going higher. I wanted to talk about some of the stocks that we put on the list recently, and we commented on in the report, the March monthly wrap-up report we sent out to members. Let's see, Gil, if you could put up, well, I guess let's start with the first one, Silicon Motion, SIMO. And here's a stock that it's been one of the few that's done really well. And as we said, that this is the kind of stock where when you have this big gain, well, for instance, it took place yesterday. This is the sort of gain. It is on good volume and everything. And in normal trending markets, that would be non-QE markets, you hang on to that, and it would probably be up to 50 in the next few days. But these are not normal markets, as everyone knows. So a bird in the hand is worth 3 in the bush, I'd say, and therefore you take your profits. And sure enough, today it's backtracking. Keeping in mind this is also semiconductor stock, so even in the 90s, when stocks would have great runs, I always found it difficult to hold on to semiconductors because they would go through a lot of choppiness on their ways to higher highs compared to, say, the beautiful internets back then, or many other types of stocks for that matter. So that kind of behavior in these semis, when you have the profits and you take them off the table, sometimes you're going to take them off early, but that's okay because again, baby stepping your account in this environment, getting a few percent, several percent, it can add up. And we've talked amply in our summary reports about how to go about keeping your risk to a minimum. If we look at, let's see, what's a good stock where risk is kept to a minimum? Actually, well, the next one on the list is Fortinet, and let's pull that one up because that's on track with SEMO. It's had a big run, well, a big day.
I think you mean Fabrinet, right? FN.
Yeah, Fabrinet, and that one's had it's pulling back constructively. So 2 days ago, there's nothing wrong with taking some partial profits there, but it looks like it's acting quite constructive. But you still want to keep your stops tight in this because you've got some gains, and you certainly don't want to see this go all the way back to the low 30s. 30. Where was it? 30 and a half or so. That would reverse all its gains from 2 days ago. Maybe keep your stop under yesterday's low. Just keep it very tight. And of course, market context is very important. So in other words, if the market's very heavy today or tomorrow, the coming days, then maybe you give this a little bit more leeway. But on the other hand, if the market's very heavy, that can mean the whole market is going to undergo some sort of correction, like it did many times in 2015. A lot of mini corrections of 4 to 5% in the major averages, but of course that translates to often corrections beyond 10% in leading stocks. So yeah, you want to be very careful about how you handle heavy markets. Generally, in the last couple of years, it's been better to exit and keep your profits or minimize your losses and ask questions later, because you can always get back in. There will be new setups, there will be new trades to make. So I think taking profits early is a good recipe in this environment. We had let's see, also on the list is the airline stock, Alaska Air Group, and this is a group that's been performing pretty well, and Alaska Air Group is just meandering along in an uptrend. It looks okay. It's not doing anything particularly wrong. So, this is one that you can just sit with for now. But again, if the market gets heavy, then you use that as a clue to possibly exit even into this kind of minor straight. Because if you have a 5% gain in something, there's nothing wrong with taking that profit. Holding out for the 10% or something bigger in the face of a heavy market is just greed in action, and you want to definitely keep your greed in check. I'd say that the last 2 years have been probably the most telling years for training investors to control their greed. Because when anything looks like it's just going to blast off, it just typically doesn't. See what's on the list as well. Yeah, UFPI. That's the Universal Forest Products, and here's one that had a big day 2 days ago. Now it's consolidating in a healthy manner. So if you didn't take partial profits, again, you can keep the stops real tight on this and hang on and hope that this bounce, this rally continues, because it very well could. Like I said at the beginning of the broadcast, it's very hard to predict the tops in these rallies when you have all these central banks printing money, and the money has to go somewhere, and it tends to go into hard assets and stocks. So far, this one is looking relatively healthy. Yeah, you have this O'Reilly Automotive, ORLY. That one seemingly is trying to break out. It could. It's hanging tight in there. So if you have a position in this, sit with it. Of course, back in the day, when the markets were in a strong rally, if this thing didn't break out with those markets or didn't rally with the markets, you pitch it because it would be something new to buy that would far exceed what the general markets are doing. But this is not then. This is now. So it's holding tight in there, and you can go ahead and hang loose with this one. But you probably, it seems like it gets some traction at the 20-day. So that should certainly be your point of no return, keeping your stops somewhat relative to that moving average. We also have MTSI. That's the another semiconductor stock. And here's one that had a higher volume reversal that was on the 18th of March. And this, you can see that the volume wasn't huge, but it was higher than the last few days. Also, these reversals, downside reversals, are particularly bearish patterns. They always have been. They give you clues. They don't always work, but the best thing is the odds. The odds are more on your side, especially in this market environment. So when you see something like that, it's good to take some partial profits. Then you can see that it gained some traction at the 20-day, and then now it's attempting a bounce. But again, this is a semiconductor stock, so this kind of action, this move where it has a few good days and then pulls back fairly substantially, is very typical of how semiconductors trade. And you can see that if you look at the whole pattern of MTSI, it just has that rhythm to it. So basically, when it had that, if you had a position in this, let me see here, MTSI, yeah, it went on the list on the 4th. So the 4th was the breakout off this double bottom pattern as it cleared the midpoint. And the very next day, it's up about more than 5% at its peak into new highs. But in this kind of market environment, and given it's a semiconductor, there's nothing wrong with taking some profits there because the very next day, then it's down more than 5% at its worst levels. So that kind of action's enough to scare you out of the stock at probably a small loss. So this, I think, is very illustrative of sometimes you got to take your profits the very next day if you have them. And you can see in the context with the overall pattern, yes, it is a breakout to new highs, and it does make people think it's going to keep going because that's been the pattern of normal trending markets. You want to see a base breakout, but we all know that base breakouts stopped working in 2004, which is very frustrating for me, which is why I was spending a lot of time researching how to better navigate markets outside of canceling, because big breakouts were a thing of the past, and of course that's where the pocket pivots and the whole gap up concept came to be. Let's go to the next stock. MTSI, then we got SWHC. Here's one, Smith & Wesson, the firearms company. This is one that had a nice move, but again, you have a high volume reversal on the 18th of March, and that is above average volume, and so you want to keep, when that happens, you want to keep your stops extra tight, so you'd be selling the next day, say if it broke below the low of that high volume reversal day, and then a few days later it has a big drop, it's off almost 10% at its worst levels.
Hey, Dr. K, one thing I would point out is if you bought this thing on the breakout here and you had a nice pullback to buy into lower risk, and then you sat through this run-up, by the time you get to 30, you're up 15% or so, and I think at that point, in this market, you get 10-15% profits in the stock, you definitely should be thinking about selling on that basis. So I don't even think you have to get tricky with trying to analyze the technical action per se. It should just be a general rule. I think if you're up 10-15%, just take at least a partial profit and then set a stop, maybe in this case at the, where would you set it, at the 10-day line?
Yeah, I mean, because it seems to obey the 10-day. So, I mean, at your worst level, point of no return, you'd be definitely selling it on that day. It penetrates the 10-day. I mean, it had a little mini gap down at the open, and then it proceeded to slice right through the 10-day. So, yeah, you'd definitely be out, because you'd see the big heavy volume coming into the stock as it traded through the 10-day on that down day. So,
Now
yeah,
it looks like a short.
Yeah, it's not looking good. Just pretty negative action, price volume action on the stock here. But yeah, this is the kind of market. Again, if you have a profit of 10 to 15% in a stock in a short amount of time, that's fantastic in this environment. And taking a page from that, I mean, the profit-taking rules that I've had in the VIX volatility model, but never instituted because the backtest showed it didn't need to be instituted. But it greatly enhances the reward while keeping the risk pretty much at the same level. So that's a gift, in research. When you're doing market research, if you find a variable that actually dramatically increases your reward while the risk stays more or less the same, or actually in some cases it diminishes the risk, then you have the best of both worlds. And of course, the importance is that when you add such a variable that you've gone through all the cycles, all the tests, because you don't want to be just testing one cycle, because it might work that one cycle, but then you go back several years and it doesn't work in that cycle, because then that's not a very good indicator, because then it's really you're cherry picking how that indicator should perform. So for all of you obviously who do market research, you're probably well aware of this, but I still do see research studies. Back in the day when I was at O'Neill's, he used to put stacks of research studies that would get sent to him, and he'd just say, go through these, see if there's anything worthwhile. And I've gone through hundreds of these things, and out of all of those over the years working with him, I got to say there were 2 of the studies that had any merit, unfortunately, because people get they often get tripped up, or they get there's a lot of bias, experimenter bias. You encounter this. You encounter this in the sciences frequently, and that's why double-blind tests and such are very necessary. And when it comes to the market, you really need to study as many cycles back as the data will allow, which is why I've gone back into the 1920s, 1930s, 1940s if I can, if the data allows for it, because it's a whole different era. But interestingly, that was an easier era and a cleaner era to trade, because there weren't all these high-frequency trading mechanisms and such. So I find what works today works even better back then, which is nice to see. But in this current environment, what's really nice to see is that we are, I would say, in the most challenging market environment we've seen in perhaps 100 years, because it's completely controlled and manipulated, and so most of these indicators go out the window that have worked for decades. They just no longer work. So when you see something that does work in this environment, and then you go back into the 80s and 90s, the slow 70s. 70s were a difficult time, and it's working in those decades as well, then it's something to get excited about. So yeah, to anyone who's testing models and such, go back into at least the 70s, because that gives you a good 40 to 50 years worth of data and many different cycles therein. Next stock on the list is EVIX, EVIX. Yeah, I'm going to skip on SMCI, but because that's very similar to the other one. EVIX is something that had, let's see, when did we put this on the list?
We put it on right about the 20-day line here. So that actually, let's see.
Yeah, then it had a nice,
so here,
the next day.
And I like that. I like that position because it's coming in after a big move up, and it's pulling into the 20-day. So that's actually a really good spot to put it on as a pocket pivot. And then it has a nice move. And then notice how you pull back and you just undercut the lows here, and that actually sets up another buy point. And in this market, I think you have to be very shrewdly opportunistic in trying to decipher this sort of action, because it's really normal, wouldn't you say? This sort of pullback after this.
Absolutely.
So
It's not anything wrong. It's just that, yeah. In this case, I was going to say you buy it on the pocket pivot day. It has a nice move the next day, and it's on volume, and that doesn't mean you take profits there because it's a bit premature given the prior action of the nice pullback. But then the market gets heavy and this thing undercuts the 20-day, but then has a nice upside reversal. Yeah, so that sets it up for, if you had sold it, you could buy it back there. And then right now the stock looks like it's consolidating, but in a constructive way. MXL, that's Max Linear, another semiconductor stock. This one's interesting because we put it on the 16th, and it was a breakout move, and of course we always advise buy on weakness. So the next day it had a nice pullback on a lower volume, so you could have bought there. Then it doesn't really do anything until the 24th, where it opens down. So that's where you basically you just sell. You probably sell at break even or something, depending on where it opened. Let's see on the here.
that pullback, right, Dr. K, believe it or not, that pullback occurred in the first 10 minutes of the trading day, and there was absolutely no news that I could see other than some positive news that in China they were going to use some of their hardware in a cloud system. But yet the stock just tanks immediately in the first 10 minutes of the day, and then see. But here's the thing: if you're laying back, let's say you had sold into the move up towards 19. If you're laying back on that day, you might see it coming down to the 50-day if you're lucky. It's also undercutting this prior low here, and you could step in and maybe buy it. But because in my view, and this assumes, number one, that you don't own it, and also assumes that you didn't try and buy it at the 20-day, but you wouldn't have been able to probably because it tanked in the first 10 minutes. So if you're watching your screen and you didn't own the stock, you might see it instantly trading down at the 50-day, and you could shrewdly step in and buy the stock. And I think that's really the way you have to operate in this market. You have to just be incredibly shrewd in terms of your buy points and trying to come in on weakness. So anyways, I just thought I'd point that out. Continue as you were.
That's a good point. I was going to say just finish it off on this one with buying it. If you bought it on weakness the day after we put it out, with the advice of buying on weakness, then you would be selling on that on that would be on the 24th when it started the day mini gap down. There was no news on it, but still that action is negative, and if you sell it right at the open, you probably are flat on the trade, maybe up 1% or wherever you bought it originally.
Yeah, if you weren't in the bathroom at the time, because it happened.
Yeah.
It depends on how much time you spend in the bathroom. But here's the odd thing. Okay, that was a sign of weakness, you say, but yet the stock is almost right back at its old highs. And in this market, it seems to me that what is a typical traditional or historical sign of weakness is really a buying opportunity, and that's what the market has become. As I see it.
That's why first rule, of course, with stocks is risk. So risk control. So had you bought it on the 18th, the 17th on weakness, then you'd be selling on the 24th. But you have to be nimble and fluid. In markets really, but especially this one, because then it managed to claw its way back. It's still down 3.4% on the day. But yeah, this is it's giving signs that there's some accumulation going on. Now it's drifting higher, and we'll see what happens from here. But yeah, if you bought it on the 24th, then sit tight with this one because it looks like it probably wants to go higher, especially should the markets rally. Next one is the Sedge, Solar Edge. This one
it's a dog.
we put on the 2nd of March, but the problem with these stocks is that they're quick plays. I mean, they're swing trades because the solar group just doesn't really go anywhere. It's a lot of noise in the pattern, as you can see. So, with this one, it just kind of after the pocket pivot, you can buy it on the weakness, and then probably be selling it on the 14th of March because it has a high volume reversal there. And so this trade would probably be closed at a small profit or break even, I'd say. That's the group just, it shows promise, but then it never really goes anywhere.
No, I think if you're looking, I think that the problems here might be related to some of the bad news you're seeing with stocks like Sun Edison, which you're saying is on the brink of bankruptcy. And you've seen some of these others like Vivint Solar has been hit, Spewer, SunPower has been hit. Just let me pull those up real quickly.
Yeah, FSLR for solar. All these have these choppy patterns.
This one looks the best. First Solar looks the best, but if you look at like SunPower, for example, that's just kind of flopping around. And I think I've talked about this one is almost looking like a fractal head and shoulders. If you look at it on a let's pull up the weekly chart. Oh, come on, Gil. I am mouse handicapped here, or challenged, shall I say. You see it's very choppy, and it's looking like a head and shoulders with a descending neckline. And so this, could be headed for the chopping block pretty soon. But the whole group seems weak. But one thing I would notice about Solar Edge is that it did undercut this low the other day, and that actually set up a decent trade for about not quite 7-8% to the 50-day line. It reversed there. In my view, it's still just kind of hanging out and setting up. This is probably one of the better names in the group, so it could come back to life. But as far as this pocket pivot goes up here, where we first put it on, that was pretty much out the window once it couldn't hold the 50-day moving average, or even that was on top of the 200-day up here. So even then, you could have just bailed. Anyways.
Yeah, and then your loss would be contained to probably like 1% or 2%, just because you're buying on weakness back there, and then it doesn't hold it, so then you're out. So a lot of these trades are made on an intraday basis or one-day basis in this kind of environment, and that helps with your risk control because you're keeping your trades very clean by keeping your stops tight. The next one is Eli, Ellie Mae rather, ELLI.
Eli was Callaway Golf way back in the day. Are they still around? Since you mentioned it.
I have no idea.
Yeah, they're still around.
No idea,
There they are, $9. I remember when this one came public in 1991, right when I was becoming a broker, and it was a hot stock. Everybody wanted to get stock because we were all cold calling with it, and we were cold calling golf courses and going to golf courses and actually like Rancho Park in LA and hitting up golfers that looked like they might have some money who were pulling up in Mercedes and other fancy expensive cars, most of which actually probably turned out to be leased. But I remember this one, you just kind of triggered that memory because it's one of the first stocks that came out along with Marvel Comics that were hot things to get on the phone and pitch back when I was cold calling, starting out as a broker way back in the early 90s. Anyways, back to Ellie, Dr. K, go for it.
Yeah, Callaway, I have fond memories of that one. There's certain stocks, when they were hot, and you could make money off them. They always bring back the memories. But this one we put on the list on the 29th in the breakout. And like we say, we buy on weakness. Sometimes sometimes the stock will just keep moving higher, like this one has. So you might be left out. But again, that's the nature of this market. It's better to control risk by buying on weakness than to buy on breakouts only to see the next day the stock reverse course, which is happening more often in this environment. So for every Eli stock that moves higher after the breakout,
I mean Ellie.
There's more that, yeah, Eli, Eli is the other one.
Well, Eli would only have one L. That's the way I'd look at it. But I guess you'd call it whatever you want. It's just a symbol.
Pronunciations. Finally, we have Facebook, and this one had a pocket pivot, semi-breakout. But as we've said, buy these pocket pivots on weakness. So it's showing weakness. It's come back almost to the 10-day. But it's a very reluctant pattern. You know, these leading stocks just don't seem to want to really go a whole lot higher. But should the Nasdaq 100 continue, and it's been showing some strength, then this one will probably get dragged up with it. You know, that said, it just since the correction, you know, this stock and Google and Amazon, etc., they're just not showing healthy technical action. Because when you see a market bounce and these don't, and these are lagging that bounce, then something's wrong.
Dr. Cat, I don't know. I'm not so sure I would say that they're lagging that bounce. This has actually done reasonably well. How much is the market up since February 9th, say?
Well, I'm saying in overall context of the whole pattern of Facebook.
Well, it's coming. It's in a deep pattern, but traditionally that's not the sort of thing you look for. But in this market, that's exactly the sort of thing that's been working. Like this Alaska Air is a similar situation, and down here when we put it on as a pocket pivot, why wouldn't you say that that's weak and it's lagging and it's the pattern isn't right, blah blah blah? But yet here it is all the way back up at the highs. So I think you kind of have to throw out what we used to think of as a weak pattern or a pattern that has a low probability of working, because these turkeys actually work. And you know, I sit there, I'm amazed, but I have to admit, I've simply gone with the flow and bought a lot of them, and it made money in the process. So I would say this could be on the comeback trail. It's possible, you know. So that's just my, my point.
I think it could set up and go, and then it would have redeemed itself. But right now, I mean, it's kind of been a long wedging pattern, and you know, it's of course relative to the markets, and something like ALK, which undercut its low in February and then bounced along with the markets, and bounced fairly aggressively, I might add. You know, it's almost at new highs, so it's outpacing the markets, and that's why you know, this pattern to me looks more healthy than, say, well, the Google and the Facebook. It's just if you look at Google, it's really dragging. You know, for a leading stock, this should already be at new highs if it's a leading stock, and I would argue the same for Facebook if it's a leading stock. So it's showing kind of that these leaders or these big mega cap stocks are just I don't know. The institutions are involved in them, of course, but it doesn't seem like they're completely convinced to really send these stocks off to the races.
Well, I would say that's probably because there isn't any, say, intrinsic accumulation of stocks, because there are no real money flows into the market outside of QE. So you don't have these secular money flows that we saw back in the 90s, because money's really not flowing into the markets. It's been flowing out. So yeah, I think they're just rotating around, and that's why as they're rotating around, they're picking stuff off the low. So yeah, you can make the case that Amazon is lagging and this is leading, but I'm sure as hell not going to buy Alaska Airlines up here. I would have gladly bought it down here on a pullback here, but Amazon, look at this, and here's another example of this sort of stuff. You have the stock move up off the lows of February, and you rally it right up into the 50-day, and it looks like you're going to roll over and break down. So you come down to the 200-day, you bounce again, and now you break the 200-day. So now it looks like, if we look at this on a weekly chart here, let me pull that up. It's looking like a head and shoulders, and I like that arrow hanging out in there. Let me get rid of that. But it's looking like a head and shoulders formation here, and it's starting to roll over, and it looks like it's going to break. But what happens? It actually ends up undercutting this prior low right here. You can see this low here. It undercuts this low, shakes everybody out, but notice the volume isn't all that heavy as it's pulling down in here. And it turns, and on below average volume continues out to new highs. So yeah, so this is your buy point, and this is what you're looking for. Okay, you're not looking to buy a breakout like some idiot who just read how to make money in stocks and thinks they're going to make a fortune buying breakouts. You've got it. Like I was saying earlier, you have to be shrewdly opportunistic and willing to buy on pullbacks, and a lot of stocks have worked out pretty well that way, and it's just, that's the type of market we're in. It's screwed up, you know, but that's what it is.
A lot of stocks that show this kind of price volume action as it undercuts, in this case, the 200-day, go lower. So you have, I mean, as you know, it's essential to keep your stops really tight when stepping in and buying these ugly ducklings.
Yeah,
Because of
definitely,
course we know
definitely.
there's a lot of ugly as well.
But I think you're in a better position trying to play the market this way than trying to buy into strength and something that looks really good. Although there have been some breakouts that have worked pretty well, like Broadcom is one, the Silicon Motion, etc. But look at, say, something like this. So, and I like this conversation we're having. I think it's a little more dynamic than the usual lecture that I'm doing all the time. But let's look at this one, for example. And these are stocks that I've played. Workday. Initially bought it here along the 50-day. It runs up to the turn a day. Okay, normally, and I was pointing this out yesterday, normally that sort of move, that would become a shortable move. But what does the thing do? It sets up tight, and the volume dries up here on the weekly chart, sets up tight, and now it's popping through the 200-day moving average, and it's a couple of 5-day pocket pivots, and usually I'll look for clusters of them, 2, 3, 4, 5, the more the merrier. And now the thing is pushing back above the 200-day line. You had a pullback this morning, opportunity to buy it. Look at now Salesforce, almost very similar. Had a pair of 5-day pocket pivots. Now, if you exclude this volume, 9 days ago, okay, that was on triple witching options expiration. If you exclude that as an anomaly due to options expiration, you could say then this was a pocket pivot off the 20-day line. So if you see it coming into the 20-day line, and this is what I do, I watch these things. I got my list of these ugly duckling setups. They come into the 20-day line, boom, I'll take a position and keep a pretty tight stop in there. But I find that they invariably work, and it's quite amazing to watch. Here's another one, even data. You know, this one this morning hit the 10-day line. I actually bought this thing, and I've traded out of it for a quick buck and change. But I've also bought some Splunk off the 10-day line, and then I traded out of that. So I'll work these as trades. You know, and they work, and you can chip away at them, but eventually you get a nice move like you're getting here with CRM and Workday. Well, Workday first, CRM. Somebody says, so when would you have bought Amazon after it hit below the 200-day? Well, this is what I talked about when you have to be shrewdly opportunistic. You know, and everybody always wants some sort of a hard and fast rule, but I was actually shorting the stock at that point, making some money. But as you all should know, or at least those of you who've been around for a while, when a stock is coming down and I'm watching it undercut a prior low, which is exactly what Amazon was doing back then. Let's go back to that chart. On this day here, okay, when it's undercutting that low, I'm watching my 620 chart. So that was 321. So let's take a look. We got to spin back a ways here. So give me a second here. Are we at 321? Yeah, this is what it did in the morning, and then if I'm shorted, I'm watching this turn. Now, what do? You get a MACD stretch down here, so it's starting to tell you that you're getting a bit stretch on the downside, and then it turns back to the upside. You get a 620 buy signal. So at that point, that's where you flip out of your short and you cover, and that's what I'll do, because number one, you're coming down and undercutting a prior low, so you're susceptible to an undercut and rally. Now, once you have the rally, it could become shortable again, but if you were going to buy that, sometimes I'll flip and go long. So you'd buy it in here, and that's how you do it. But you definitely have to use your brain, and it isn't something that you can mindlessly look at as some sort of a move you can buy into without thinking about how you're going to handle the trade, and also taking into account market context. The other thing is that the Amazon sell-off was caused by news that Apple was going to move their cloud business over to Google's cloud platform, and since then it's come to it's surfaced that ain't going to happen anytime soon. So the stock has come back, but the volume it's not that exciting, but it's making higher highs anyways. So Dr. K, what was your next name? Go ahead and continue with what you were.
That's the whole list.
Okay.
I mean, well, we basically, let me see here. We put a couple new ones on as well. You know,
the CMN is one.
Yeah.
Too thin. I think it's too thin. Trades 190,000 shares a day. It's like this UFPI. which trades 139,000 shares a day. I mean, to me, that's I can't play those names, so I don't even bother. But and I think they're too thin for anybody who plays any size. If you have a small account, you're going to buy 1,000 shares max, and these might work 2,000 maybe.
When you say you can't trade it, you have to consider that there's a lot of people with smaller accounts.
Well, that's what I'm saying. If you have a small account. But still, I would say this is not really an institutional name. You know, there might be some small cap funds that take a position here, so there's some of the buying.
About $15 million volume. So yeah, it's on the borderline of being on the thinner side. I think the important argument is that there's some market environments where thinner names just don't do well, or the odds are against them. And yeah, this is you could say that in some ways this is one of those environments. That's why if we put something on the list that is on this level, where the average daily dollar volume is around 15 million, then it has to really check all the boxes. It has to outshine its heavier or larger cap counterparts for it to make it through our filters. You know, this one, well, I guess it finished basically even. It was still down a little bit on that day. I'd said that if it, you know, it should close roughly break even for it to qualify as a pocket pivot. You know, just the fundamental story and et cetera, you know, just cleared it enough. It seems like it has nice clean. The other thing that's nice is when it does go on a run, it tends to hold for the 20-day, 10 or the 20-day. So it does have some clean runs in there. So, you know, all that, of course, gets analyzed. You know, if it's a choppy name and a thinner name, it generally will never make the cut because there's just too much risk in the pattern, plus it being a thinner name. And we've also, in this environment, that is over the last couple of years, we've seen a lot of thinner names spin out. So the way markets are made in these stocks lends less confidence to trading thinner names, because however the markets are made in them, when you get some kind of weird action going on that I can't explain, but you can see it on the charts, and you have to be careful about these kinds of things. So yeah, we generally take a position of reluctance with the thinner stuff. Generally in this market environment, you want to see north of 20 to 25 million dollar daily volume. And then what else? We also put on WebMD today. Here's one that it had a viable gap up and then it held itself, so we put it on the list. And now it's up even more. Now it's up about 5.5%. Now it's getting away. Now it's too extended. But when we put it on, I think your downside risk, if you use the undercutting of the low by say 1% or 2%, your downside risk would have been probably 4%. But now your downside risk is going to be with downside risk originally was 3 to 4%. Now your downside risk is going to be somewhere around 5 or 6%. So it's getting a little bit long in the tooth there. But again, you can buy these on weakness. A lot of these viable gap ups will retrace.
My view on this one, Dr. K, is that it's in a very extended position on the weekly chart, so it's not clear to me necessarily that's going to take off. So definitely, if you can buy it as close to the low as possible, you want to keep your risk pretty light. Here's a gap up I bought this morning from yesterday. It pulled in this morning and I bought it, and the stock is now turning green, and it's maybe in a little better position. I don't know if that, that looks like a viable gap up to me. It's coming out of this handle area here. This is Lululemon. This is a stock that was one of my favorite shorts a while ago, a couple years ago. But this usually when I'm looking for viable gap ups, I want to see them occurring out of a consolidation somewhere. Like I thought the Avago was a very good one that we put out there right here, and then it had a nice pullback to kind of fill the gap. And it's turned around and gone higher. That's one. Have we had that one on our list?
AVGO. Let's see here. I don't know.
That might have been. I thought we did. Maybe not. But that's one. That was a viable gap up coming out of a position that's closer to a base. When they get extended in this market, I'm a little wary of buying them up like that. So I'm just pointing that out for anybody who's looking at this one. Although I think that I like this consolidation that it was in here along the 20 days. So that's, I mean, that looks reasonably good since it was hanging along pretty tight along the 20 days. So it's definitely worth a shot. But my preference is to buy them when they're coming out of neat little bases or consolidations somewhere in their patterns. Here's one. Let me throw this one out, Dr. K. Amberella. Ugly duckling, looks like a piece of garbage. You look at that pattern, you never touch it in a million years. The only problem is, oh, I don't know, a third of the float has been sold short, and you had a gap up move here. It could be a turnaround story, but that one's actually working, and you'll see some of these. I think some of them are playable, you know, in some cases. Look at Mobileye. Here's another one that I've liked. You buy it at the 20-day, it runs up, pulls into the 20-day, you buy it back. So you sell into the 10% move, and then it pulls into the 20-day, you buy it back, sell into the 10% plus move, and now it's coming in. But this one also has slowly come up off the lows, and you're seeing a lot of these. So I wouldn't be surprised to see some of these continue higher if the general market rally continues higher. Even Tesla, you know, I keep thinking this is a short, but it wants to hold the 200-day line here, and it did reverse after hitting these highs, and it just comes down into the 20-day line. Almost the same thing it did here when it failed at the 50-day line. It comes right down into the 20-day line here. Let me get my pen right here. So you see here it comes in 20-day line, but here again you get this pullback, and now you rally back above, and you're sitting tight along the 200-day line. They come out and announce the Model 3. What's your take on Tesla overall, Dr. K? Do you think they're going to become the new million-selling car company like Ford has done with the F-150 truck? Maybe they need to come out with an electric truck.
Yeah, I think they have a lot of competition, and they, first mover advantage. So that of course has some merit, but I think their heyday of big gains and their stock price is over. I think they'll stick around, but I think that the big moves have been made, and it's kind of like a lot of these names that they have their best years. Like Google, its best years the first 2 or 3 years, and now Google's in so it just gets, the size of the company gets to the point where it no longer can make huge moves in a short amount of time. Google's biggest moves were made in the first 3 years, and that can be said for quite a few of these companies. Just because I guess the sheer size of them relative to the marketplace gets to the point where they can only move so fast after a certain point. That's the whole thing about Apple, is that it's really defied gravity in terms of being the largest company. It was about $700 billion market cap at its peak, and it's arguably how much more is it going to grow from here? I mean, relative to the size of the planet's market for these gadgets and iPhones and whatnot. If you want to, I guess, have a safer blue chip play, maybe this is one of them. But if you want to make money on the upside, when as it crossed beyond 100 to new highs, and it peaked at 134, you're not, the time value on these stocks starts to erode when they get very large like this.
Yeah, this one, Dr. K, Apple's looking like it's in shortable range, but my guess is it would only work if we see the general market roll over or correct. So, and you notice here, you have this big head and shoulders formation, which I've drawn here. I've done a beautiful job of that. But like I said, I'm challenged with the mouse here. In any case, you're up into this neckline, which you could say is anywhere in this zone. Whoops, up in here. So let me color that in. How's that look? Look pretty good. So there's a big fuzzy zone. Maybe it's uglier than a fuzzy zone. I don't know what you call it, but a tangled zone here that I've drawn. But you're right up into the 40-week line and the neckline. And so I'm watching this thing to see if it becomes shortable. And you're seeing it's not quite to the 200-day line, but you had a gap up move yesterday, and that was pretty good volume. So I'm wondering if it's going to make a run for it. So I'm watching Facebook. I actually have been buying it as it comes in, and I'll tell you why. As long as what happened here? Oh, here we go. It's doing a sort of a Wyckofian retest intraday. So you tested the lows here. Volume's been drying up. You see that on the 5-minute chart. If you look at the daily chart, you came within 1% this morning of the 10-day line. So, you know, if something comes in within 1% of the 10-day line, I'll start taking a shot. I'm not afraid because, you know, if it goes through the 10-day line, what are you looking at? 1-2% on the downside. So it doesn't really scare me there, but I'm just noticing stocks trying to push higher. It is the end of the quarter, so I'd almost expect them to push this thing into the close. What it looks like to me is you see a double top here, and somebody is selling into this because they see it as a double top. Also, the other thing to keep in mind is that a lot of institutions own Facebook, and I don't know if you remember this, Dr. K, but I remember most of the mutual fund clients we had back when we were at O'Neill, they were mandated to have 2% or less position. I remember the New USA fund when O'Neill started that and David Ryan was running it. It could never have a position larger than 2%, which I remember at the time I thought that was kind of dumb, because the real trick behind a Can Slim or O'Neill style approach is to find names where you can get heavy and, you know, have a 50-100% weighting, which is the way I made big money in the past. But a lot of them, it's like 2%. And so what happens is as the thing moves back up, you know, to highs or makes new highs, it becomes too big a part of their portfolio, and they're mandated by their charter to cut the position back. So a lot of times, as something starts to come out to new highs, and that's where you get pullbacks after breakouts, they'll sell it. So it was below average yesterday, but coming in, I mean, if you look at this pattern, that looks like garbage. You know, it's just like a breakout straight up from the bottom, pulls in, holds the 40-week line roughly, which was basically filling this gap in here. If you can see, it comes down in here and it fills this gap. Let me get my pen. Here's, whoops. Can you guys see it? Let's see. Pen. Here we go. Here's the gap. So it fills it here, fills the gap. See that? And that's from a point just above the 200 line, and heads higher. Now it just continues going higher, and there's no real volume in here. You get 1 day of volume, but that was on options expiration, triple witching, and then it continues higher and it makes an all-time high the other day on a closing basis. So it needs to get above 117 to make an all-time high on an intraday basis. But in any case, this looks like garbage. I mean, wouldn't you say this pattern on the weekly, Dr. K, would you generally want to buy into that?
Well, yeah, in conventional markets, never. You would touch it with a 10-foot barge pole. But,
no.
You know, the thing is, mutual funds have those strict mandates, and that does help understand some of the action in these institutional names. But at the same time, they are institutional names, so you know the counter argument, I guess, is if the market trends higher, this of course will trend higher with the market.
Right.
You know, it still is a leading stock, so it should outpace the performance of the major averages.
Right.
And so this rally could carry on for another few weeks. Who knows? You know, you could with another, you know, a 10% in this thing from here. So that's, you know, we put it on the list as a pocket pivot with a caveat buying on weakness, and you know, this kind of using the intraday 620 as your guide is something that works very well on getting a clean entry and knowing exactly where you're going to get out of the position.
Yeah, and here's the 620. See, it's starting to turn, and so I'm looking at I look at Wyckofian lows, a retest, and somebody the other day asked me if Twitter was a Wyckofian retest, and I would say no, because this is the low they're looking at, which was in February, and this pullback into that low to me isn't necessarily a Wyckofian retest. In my view, it's generally quicker, but it is trying to round out here, and maybe it's going to turn. I don't know. I've been trading this thing off the lows. It seems to get these bounces every time it undercuts to a new low, but you know, not much else after that. But usually a Wyckofian low, like if we're looking at it on a 5-minute chart, and you can't really see it unless I move it over to the left, so all that other stuff disappears. You can see here that you did have that on. See the really light volume on an intraday basis. The volume is extremely light. A little while right there. You see that one? That was 5 bars ago. So as it's coming in and you kind of shake out right here, you see you get a little hammer. And so this is where I'll be stepping in, although I'll start buying it when it gets to about 1% of the 10-day line. So yeah, that's just the way I roll, and that works in this market. And you have to be opportunistic this way. I don't think it's much of a buy and hold market. There are a few things that work, but that's kind of what you're doing. So this looks gross to me. If I was looking at model book stocks and the bases, I'd say, oh, this just doesn't fit. But it could go higher. It's a market stock, and I think when you're talking about a market that's driven less by secular money flows coming from investors into mutual funds and into the market and more by QE, I think this sort of rotational action is typical. And I also think that you'll see odd patterns occur because nobody's really selling even though nobody's really buying. So this thing could just form a handle and then take off and go higher. But what I'll do is I'll trade it on a short-term basis trying to buy into weakness. Somebody says, isn't Apple on a weekly chart volume declining? Yeah, you can see that quite clearly. It's wedging it right into the 40-week line. So in my view, this looks like a short up here. And if the market starts to get in trouble, that's probably one I would go to immediately. So another one might be Netflix, which is, you can see, is wedging up into its 40-week line. But this is what it looks like. It had a pocket pivot in here, if you can see that. Can you guys see where it is? Right here. Right there, I believe. Is that right? 1, 2, 3, 4, 5. Yep. And it has a pocket pivot coming up through the 10-day line. And now it's headed for the 200-day line. This one came up the 50 days down here. So it's kind of stuck in no man's land. But don't be surprised if this goes higher with the market. So, c'est la vie. That's the way. That's what you're dealing with these days. But that's one that I'm watching as a possible short. But again, I'm just watching these things because guess what? So far they aren't acting like shorts. Even Apple, I went short yesterday. Made a buck as it pulled in a little bit off the highs. But it ain't going anywhere, and it's holding tight after this big volume gap up move right here. So. But yeah, it's strange market and getting stranger all the time. So I noticed Dr. K Gold is farting around here after having a nice move off when the market started tanking in January, gold had its best move, and it basically peaked out roughly at the same time as the market. Now it's kind of hanging out as the market seems to be rallying in anticipation of continued easy money, money printing. So gold, on the other hand, hasn't taken off. And Dr. K, do you think it will eventually here? Does it look to you like this wants to go higher after some consolidation of those January and February gains?
Well, I think the technicals on this very, very hard to predict. Obviously we'd like to say it looks like it's setting up to go higher. But there's so many cross currents in gold. That's the problem with using technicals to any extent in the long run. I mean, the only technicals that I found work with high reliability on something like GLD is when the base consolidates after a very long time, typically many months, if not over a year, and then breaks out on good volume. And it's usually a very clean, obvious breakout to even untrained chart eyes can spot it, I would think. And GLD has done that a number of times in the last, I'd say 15 years. And those are just gifts. They're so clean, and it's a trader's dream. So, but that said, right now on a fundamental basis, I think, the gold is the fear trade. So we saw that in January and February. It also represents a loss of confidence in governments, and I think that's going to continue to build as long as central banks continue to print without being able to stoke any kind of meaningful global economic growth. So, and we know that today China's bonds are downgraded again, and that's another straw on camel's back. So as these straws start to accumulate on the backs of camels, at some point there's going to be a final straw. So,
at some point.
What's that?
At some point, yes. The hard thing to figure out is exactly when that's going to occur.
Right, and well, I think we'll see it. I mean, the market always gives clues whenever it has a serious correction. When I say serious, I mean things that led up to, major corrections in the past. 2008 is an obvious one, but the flash crash, 2010, etc. These are preempted by negative technical action, leading stocks and major averages. That said, we're in uncharted territory, so I don't want to say just because this is the way it's always been, it's going to continue to be this way. We could just have a day of reckoning, the very next day without a warning. Who knows? Hopefully that doesn't happen. If that does happen, then obviously we, just exit at the open because the signs will be there. You just want to get out and control your losses. But as far as gold here, if the markets continue this QE uptrend, and of course that will be met with negative stories of global growth. That's what's happened, of course, in the last couple of years. When you see these sharp pullbacks, it's usually China's slowing, Germany's slowing, the U.S. is slowing, and then the central banks, Bank of England, Bank of Japan, ECB, step in, or the Federal Reserve steps in and says, don't worry, we're going to make sure rates are even lower than they've been. And so, of course, that causes the shallow floors. And it's just this constant tug of war. And, gold hasn't made any real strong moves up until recently, which I think is important in context of the fear factor or the loss of confidence factor. That this big move we've seen this year in gold is not something to just ignore. I think it is another piece, it's another clue to the puzzle that that confidence is eroding, and I think it's eroding faster now than it has in the past. So I think people are starting to wake up to how waking up to the cluelessness of central banks and not knowing really what to do next. And so that's why at the beginning of this year, I wrote that report saying, this year is more than likely to have a lot of volatility compared to prior years, which is good because volatility, that's where you have a lot more profit opportunity. You just have to be very quick about it. And the VIX volatility model is a good example of that, where it has had a number of these very quick profit days. And then rather than just sending out a note that I would saying, oh, you might want to take some partial profits here, the algo now has an actual profit-taking method behind it to try to maximize the gains on those days, but also to not let them go back to zero, which in this market environment, a volatile market environment, can happen. Which is such a shame, because when you have a 15% gain in 1 day or 2 days in this environment, I mean that's platinum. That's it's beyond gold, or in terms of the time value therein. So, all that's to say, don't ignore the price action of gold. If it starts to continue to show strength, that's perhaps a clue that not all is well. And as we go forward, it's guaranteed pretty much that we're going to see some negative economic report, or substantially negative, out of China or Germany or the U.S. And that, of course, will set markets back. And the question is, how long can this tug-of-war keep going before the rope just breaks? So I think that's the burning question for this year.
Okay, a couple of quick questions before we end. Somebody's asking about SHOP. I don't really like SHOP because it's a thin little name. It's right at the 40-week line, so I know it's coming back to life. You have a gap up here, but it doesn't really hold. So I don't really care much for it. Somebody's asking what indicators used to work prior to QE that no longer work other than breakouts. Well, not necessarily indicators, but just the idea of a nice. You look at bases and there's a nicely constructively formed base. There's a lot of weird looking bases in this market, and they work, and that's one thing that throws you off. So volume also, I think, is a factor, because you'll see things rise and rise and rise, and there's no volume. So volume as an indicator, I think, has become somewhat less reliable, and some of that may be due to the fact that, and I don't know this for sure, but this is what I've read and been told, that 80-90% of the volume that you see these days is all machines, and a lot of it's HFTs, or high frequency trading funds, which are doing nothing more than trying to scalp a few tenths of a penny off of everybody else's trades. And so I think there are some things that have changed, but you know, we have concrete ways of dealing with it. Buying pocket pivots as stocks are rounding out uh, the right sides of bases, like with ALK down here. On this pocket pivot here, it's worked well, and you know, normally you'd be sitting here waiting for this to break out, and by the time it does that, that might be the end of the run. I thought I'd leave you guys with something real quick. Here's a chart of the percentage of stocks on the NASDAQ that are currently above their 50-day moving average. And you can see here it's at an extreme peak, but if we go to, let's take it out to 5 years. Hopefully you guys can all see this. This is from the great website, I think it's a great website, stockcharts.com. I actually have a subscription. I think it's 120 bucks a year, and you can create watch lists, and you can run screens, very simple screens. And I think it's just one of the best systems out there. And the beautiful thing about them is that they don't care who uses their charts. If you want to use their charts in a report or on a webinar or in a website or whatever, they don't care. I use them in you know, all the time in presentations. I also use HGS Investor software because they have the same position, whereas O'Neill has a stick somewhere stuck up there, you know what, where they don't want anybody using their stuff, which I think is a foolish maneuver on their part. And I remember this is something I argued vehemently against when I worked there, which is that they were overly proprietary, and you build your following by putting your stuff out there and letting people use it, you know. People would learn more about Daily Graphs and MarketSmith and whatnot if it was out there and people were showing it on websites and whatnot. So these guys, I think it's a great service. So people who ask about what charting services do you think are good, this is one I think is good. But you can see you've gotten to a peak here on this, and you can see this here along the highs of this, and this is going back 5 years. And you can study this along, if you want to do a comparison chart, you can do something like this. Let's see if I can do this correctly. You go down to indicators, and I think you put in price. 1, 2, 3. Let's put the NASDAQ in here, and we're going to put it behind it, and let's update that. See what comes out. Yeah, there you go. Let me get rid of the. So you can see you can correlate peaks in the market to peaks in this here, you know, in here and here. Here, there's a peak here, and so you can just do this, you know, do it on your own, and you can get a sense of when you get this high, and we could go higher. We could go to 80% before any of this gives way. So keep that in mind, because you have done that in the past, okay? But each time, roughly, it tells you you're getting close to a peak. Now, notice if we go back into 2012, you had a peak here, but that occurs, the market continues going higher. So it's not necessarily a guarantee, but it just gives you an idea that you're getting long in the tooth here. But here's what I think is interesting. If you look at 200, we change it to 200R. If we look at the percentage of stocks on the NASDAQ that are above their 200-day moving average, you notice that you're barely up to 37%, and it's definitely lagging. I think a lot of this is due to the fact that you have a lot of these stocks that are actually above their 50-day, which is below their 200-day, so they're also below their 200-day. So while they're above their 50-day, the 50-day is well below the 200-day, so they're still below their 200-day. And I think that a lot of stocks are like that. Now, does this tell you that the rally is weak, or does it tell you that there's more room on the upside? You know, and you can go back and study this one. I think the 50-day is a little bit more relevant. I know at O'Neill we used to use the 150-day on this. Remember that, Dr. K? And so that's still not really getting up there either. So you may have some room to run here with a lot of these stocks. But it is something to keep an eye on, because you are getting somewhat extended to the upside. Anyways, that's all we have for this week. Hope it was helpful webinar. I like the back and forth there on the individual names, Dr. K. So anyways, you guys have a great weekend. We got the jobs number tomorrow. We'll see what happens. And I wouldn't, you know, a lot of people ask me, well, what do you do with your positions? If you want to lighten up, go ahead. But if your stocks, you bought them in a good position and you have a profit cushion, if that's the case, generally I don't have a problem sitting with some stocks. I might have a short, you know, so you might look at something like Smith & Wesson here, which is in this bear flag, you know, throw that as a short with the idea of using the 20-day line at 27.21. as a quick cover point, or you could use a 2750 level up on these highs of the prior 2 days. But the one thing about this is it broke down because Sportsman's Warehouse announced on Monday. Was that Monday? No, it was last Friday actually. Sportsman's Warehouse announced that they were seeing slowing down in gun sales. So if that's true, then this stock is probably in trouble. And the first indication that you might have a failed base breakout is that the stock will initially bust the 20-day line on heavy volume. So you have that in this, and now you're in a bear flag, which could indicate that this thing is going to break for the 50-day. So that's one. I might have one of these short and a couple of longs going into tomorrow, depending on how my stocks play out today and whether I have nice profit cushions, which is generally the case if you're buying earlier in the week on weakness. So anyways, you guys, that's all we have for now. Have a great rest of the week, and we'll catch you next time.
So long, everyone.